Tesla lost money every single year from its founding in 2003 until 2020. Over the decade from 2010 to 2020, the company burned through approximately $10 billion in cash. In 2018, Elon Musk was sleeping on the factory floor, working overnight shifts on the assembly line, and crying during a New York Times interview about the stress of keeping the company alive. And then in 2020, the stock rose 740%. Tesla became more valuable than Toyota, Volkswagen, and Ford combined, despite making fewer cars in a year than GM makes in a week. If you can explain why that happened, you understand something important about how financial markets work. Let's try. Tesla lost money every single year from its founding in 2003 until 2020. Over the decade from 2010 to 2020, the company burned through approximately $10 billion in cash. In 2018, Elon Musk was sleeping on the factory floor, working overnight shifts on the assembly line, and crying during a New York Times interview about the stress of keeping the company alive. And then, in 2020, the stock rose 740%. Tesla became more valuable than Toyota, Volkswagen, and Ford combined, despite making fewer cars in a year than GM makes in a week. If you can explain why that happened, you understand something important about how financial markets work. The first thing you need to understand about Tesla's valuation is that investors were not paying for current earnings. There were no current earnings. They were paying for a belief, specifically, the belief that internal combustion engines were in the early stages of a decades-long decline, that electric vehicles would eventually dominate global transportation, and that Tesla would be the company that dominated electric vehicles. If you believed all three of those things and bought Tesla stock in 2015, you made extraordinary returns. If you believed them and bought in early 2022, before the stock declined significantly, you lost a lot of money. The same belief, held by the same person, produced different outcomes depending on when they acted on it. This is what financial analysts call a narrative-driven valuation. A narrative-driven valuation is not irrational. All investments in pre-profit companies are, to some degree, bets on a future state. What makes them interesting and dangerous is their sensitivity to narrative changes. The underlying belief that justified Tesla's valuation didn't change much between 2021 and 2022. What changed was investor risk appetite and interest rate environments. The stock fell 70%. The company was the same company. The most clarifying moment in Tesla's history for understanding the company's genuine challenges was a period in 2017 and 2018 that Musk himself called production hell. Tesla had committed publicly to producing 5,000 Model 3 cars per week. At the peak of the crisis, they were producing fewer than 800. Musk had over-automated the factory. He'd built highly complex automated systems to replace human workers, and the systems weren't working. He eventually admitted that humans are underrated and began replacing the automated systems with human labor. Musk moved into the factory. He slept on the floor. He personally worked on production lines through the night. This is not normal CEO behavior, and it's worth understanding what it signals about how Musk manages, or doesn't manage, organizations. The production hell experience revealed the gap between Tesla's extraordinary ability to design and market vehicles and its significant struggles with the operational discipline required to manufacture them at scale. Every automotive company that has tried to compete with Tesla has discovered the design and software challenge. Tesla spent years discovering the manufacturing challenge that every automotive incumbent had already solved. Here's the detail about Tesla's profitability that almost never appears in the coverage. In 2020, the year Tesla first reported a full-year profit, approximately $1.5 billion of its earnings came from selling regulatory credits to other automakers. California and several other states required automakers to generate zero-emission vehicle credits, which could be purchased from companies like Tesla that produced only electric cars. Tesla's automotive operations in 2020 barely broke even without those credits. The profit that triggered the stock's 740% rise was substantially dependent on a regulatory mechanism, selling compliance credits to the very companies Tesla was competing with, rather than on sustainable operating performance. By 2021 and 2022, Tesla's automotive margins had genuinely improved, and the credit dependency was reduced. But the 2020 story is considerably more complicated than Tesla became profitable suggests. So where does Tesla stand today? The answer is more complicated than either the bulls or the bears typically acknowledge. In 2025, Tesla delivered 1.64 million vehicles, a decline of roughly 9% from the 1.79 million it delivered in 2024, marking 2 consecutive years of falling sales. Chinese EV giant BYD outsold Tesla by over 500,000 vehicles in 2025, seizing the global electric vehicle leadership position that Tesla had held for years. That reversal, from dominant pioneer to second place, is the defining competitive story of Tesla's current moment. Industry analysts point to two primary factors: aggressive competition from Chinese manufacturers and established European automakers, and brand perception issues stemming from Musk's political activities and public statements. Tesla's brand value fell approximately 36% in 2025 alone, a loss of over $15 billion in brand equity, according to research firm Brand Finance, which cited Musk's political overreach and a lack of compelling new models as the primary causes. The European picture is particularly stark. Tesla's European registrations fell 39% in the first 11 months of 2025, while Chinese rival BYD saw registrations in the same markets rise 240% over the same period. The company that was supposed to lead the world into the electric vehicle era is losing ground fastest in the markets where environmental consciousness and EV adoption are highest. A painful irony that reflects just how much Musk's political transformation has damaged the brand among the very customers who were its most natural constituency. And yet, and this is where Tesla's story remains genuinely strange, Tesla's valuation has surged to over $1.6 trillion even as vehicle sales decline. The market is not valuing Tesla as a car company in any traditional sense. It is valuing the robo-taxi program, the Optimus humanoid robot, the full self-driving software, and the energy storage business, all of which represent future optionality rather than present earnings. Wall Street appears willing to look past near-term delivery challenges based on optimism about Tesla's robo-taxi development, artificial intelligence capabilities, and other advanced projects that differentiate it from traditional automakers. Tesla has begun piloting its robo-taxi program in Austin, initially with safety drivers but now testing fully driverless operations, with plans to expand to additional cities in 2026. Whether the robo-taxi business can eventually generate the revenue needed to justify a $1.6 trillion valuation is the question that will define Tesla's next decade. Tesla's story doesn't have a clean lesson that applies universally. It proves that burning cash for 17 years can produce extraordinary outcomes. If the underlying technology transition you're betting on is real, if you can maintain access to capital long enough to outlast the losses, and if you can solve the operational challenges that separate a great product from a great business. It also proves that the same narrative-driven valuation mechanism that made Tesla's stock rise 740% in a single year can work against a company when the narrative shifts. When the founder becomes a polarizing political figure, when a Chinese competitor builds better cars at lower prices, and when the promises of full autonomy keep pushing back on the calendar. The question Tesla is now asking investors to answer is the same question it has always asked. Do you believe the next transition is real? Last time, enough people said yes to make history. This time, the answer is considerably less certain. And if you found this useful, hit subscribe, and I will see you in the next one.